It's been difficult to avoid the negative headlines focused on hedge funds over the past few years. Performance comparisons to public markets, criticism of high fees, and speculation and investor patience is wearing thin as a result of both have dominated much of the coverage of the sector. However, beyond the headlines, the reality of the hedge fund industry is much more nuanced, with cause for optimism as our latest global hedge fund report reveals. So let's start with the performance question. Certainly, 2018 was a challenging year for hedge funds. Collectively, all hedge funds lost 3.4% in 2018, the Preqin All Strategy's worst annual return since 2008. However, if you dig deeper into these numbers, many strategies and sectors actually navigated the market shocks and drops of last year successfully, and on a fund level there was significant dispersion between the best and worst performing funds. Some of the largest funds, those looking after capital on the behalf of the largest number of pension schemes for instance, fared well in 2018. Bridgewater Pure Alpha, the world's largest hedge fund, returned 10% in 2018. Good news for the 60 pension schemes we track currently investing in the fund. And hedge funds have had a flying start to 2019. In fact, hedge funds returned nearly 4% in January. This is the best return of the Preqin All Strategies benchmark in nearly a decade. Now on to the question of investor sentiment. It's hard to deny that relative performance over the past 5 years has been a point of contention for many institutions. With public markets enjoying an extended bull run, hedge funds charging higher fees for seemingly a smaller return was a hard pill to swallow for some investors. And as a result, we saw some investors strip back their hedge fund exposure or exit completely. But again, beyond this headline-grabbing activity, the reality is much more nuanced. Firstly, although we do not expect the established investors in Europe and North America to invest fresh sums of capital in the volume we saw a decade ago, we are seeing high levels of investor activity in terms of reallocations of capital, as investors tactically rebalance portfolios following a difficult 2018. Alongside this, investors in emerging markets, Asia in particular, continue to dedicate larger and larger sums to hedge funds, replacing some capital that may have been pulled out from institutions in the US or Western Europe. So what does 2019 hold for the hedge fund industry? The impacts of significant geopolitical events on markets continues to create challenges, and funds are looking to position themselves in the event of a market correction. However, with challenges come opportunities, and hedge funds are looking to harness market volatility to generate returns, as well as to continue to evolve their product offerings to meet an increasingly demanding investor base. And after the market shocks of 2018, the majority of investors signal to us they are positioning defensively in the expectation of a market event. So rather than past performance driving investor thinking in 2019, it's the capital protection that a hedge portfolio can offer going forwards which will be driving investors' decision making for the year ahead. And hedge funds will certainly have a vital role to play as investors look to risk off. In fact, we have seen the largest proportion of investors tell us they intend to maintain or increase their exposure to hedge funds in 2019 since 2014.